that particular fashion. So to begin with, what is the financial management function or the function of finance? It talks about raising of finances and investing in the business. So that is the main activity which is taken up under the finance function. So what are they involved in? What does the management take care of it? Raise finances and invest in the business. So touching upon the basic concept of business and owner are two different entities. See, owner is an entity which is assumed to be an artificial person. Since the artificial person or the business does not have any resources on its own, various other entities could be owner also. Owner and others have to pull up that amount and then invest it into the business so that the business becomes functional. This person, individual entity, with even if it is assigned also, on its own it cannot do anything. Therefore the funds have to be raised and invested in the business by various stakeholders. Now once the funds are raised and invested in the business will be able to take forward or carry out the activities which are planned or which are according to or on par with the objective of the organization, the vision or the mission of the organization, the strategy of the organization. So one very important role is um, the role or the function of raising finances and investing. So we are going to in detail look at what are the various types of finances. So the financing decision. So there are three different decisions which are associated here. So when we look into that, the first part of it is about the financing decision. The second one is about the investment decision. And the third one is about the dividend decision. The summary of this paper is these three decisions. But we're going to study in detail about all the three different types of decisions, okay, which are the main parts of the finance function. So there are three different decisions: the financing decision, the investment decision, and the dividend decision. So to begin with the financing decision, so what do we understand about the financing decision? The finances are raised for the business and invested in the business. So is it always that the owner, now when we are looking at the company, in the company, amount has to be raised and invested. So if that is what we are looking at, is it that only the owner invests the amount? So that is the question here. It is not always that the owner invests the amount, but apart from owners, along with owners, others also invest their amount in the business. Okay. So on that note, we classify the capital. The amount which is invested in the business is called as capital. So that capital is classified into two different types. One is debt capital, another one is equity capital. So there are two different types of capital. Debt capital, and then we see there is equity capital. How do we remember what are the features or what are the characteristics of these two different types of capital is what we're going to understand. So the funds which are raised in the form of debt capital, in the form of equity capital. Debt capital is amount which is invested by outsiders of the business. And equity capital is a capital which is invested by the owners of the business. So broadly, when we classify them, we see that amount is invested by the outsiders as well as the owners. Who are owners? Okay, both of them have their interest in the organization. Both of them are looking at some amount of returns as against the amount as against the capital which is invested in the business. So the first point of it, if capital has to be raised, capital can be raised in the form of debt capital, in the form of equity capital. Okay, so first we need to understand what are the various sources of finance. What are the sources of finance? They can be raised from the owners of the business, they can be raised from the outsiders of the business. Now owners have a liability. Okay, liability to bear the losses also, if in case if the business does not run properly. So they have a share in the profits as well as losses, so their liability extends towards that as well. But outsiders are only interested in taking a share in the profits. Even in case there are no profits also, whatever is promised against this debt capital, that has to be paid to the debt holders. So here we differentiate between the owners and outsiders, as owners can participate in the profits or share in the profits, or profits are distributed to the owners only when there are profits. So their return is subject to the company earning profits. If the company is not able to earn profits, they are not entitled to any amount of return from the company. So earning profit is very, very important or crucial for them to earn their return from the company. But that is not the case with debt holders. Debt holders are outsiders. They have a fixed percentage of return which is promised to be paid to them at the end of a particular period. Periodically, they are entitled to a return, and that is not subject to the company, whether the company earns profit or loss. So it's kind of an obligation which is to be paid to the debt holders. Debt holders are entitled to a particular percentage, a fixed percentage, a percentage which is decided at the time of raising this debt capital. So they are entitled to a return at a fixed percentage to be paid to them periodically. That period could be annually, semi-annually, or whatever are the terms and conditions. So periodically they are the entitled to a return amount which the company has to pay them. But owners, that is not the case. So in situations when there are profits earned, these profits belong to the owners. In case when there are losses, there are no profits, they are not going to be paid anything. They cannot expect anything from the company. They should take up the liability or responsibility of bearing the losses as well. Okay, but in case of super profits, all super profits are belong to the owners. So in case of losses, as they are taking up the losses, so also in case of earning profit, all the profits belong to them. Even in case of super profits, very high profits, also all of them belong to the owners. So that is what is the concept. Broadly classifying, I am again insisting that broadly classified the sources of finance. We have two broad sources of finance: debt capital and equity capital. Equity is kind of an umbrella under which we again have certain other things. In a while I will also explain what are the other things under equity capital. Okay, so broad classification of capital or finances are from the source of debt capital. Another source is equity capital. Debt capital is contributed by outsiders, equity capital is contributed by the owners of the business. Okay, then another thing what we have to remember about this is what is the cost. Okay, roughly just remember certain things. Here we're going to do in detail about what is the cost of capital of each type of capital. Now in case of cost, we see that the cost of debt capital is low. The cost of equity capital is high. Cost of debt capital is low. Cost of equity capital is high. Then another aspect what we have to remember is what is the risk. We see that risk is high in case of risk is high in case of debt capital. The risk is low in case of equity capital. Is this how the students join? Only in this number, or some more would join? Only 12, 11 are there in the class. You think some more would join?
Ma'am, I think 2 or 3 students will join later because of some urgency.
Otherwise, usually this is the step, isn't it?
Yes, ma'am.
Okay, then no problem. Okay. So we see that there are two types of capital. The cost of debt capital is low, the cost of equity capital is high. How do we understand this one? The return which is paid to the debt holders, we call it as interest. Interest is paid on debt capital. In terms of the return what is paid to the debt holders is called as interest. The return which is paid to equity holder is called as dividend. Okay, interest and dividend. So when interest is decided, when is it decided? It is decided right at the time when debt capital is called by the company. It invites the outsiders, the investors, to invest in the business in the form of debt capital. So right at the time when they are asked to invest the amount in the business, at that time the percentage of interest which would be paid on the debt capital and the other terms and conditions are decided. So how do they decide what would be the interest amount which is to be paid? The interest amount which would be paid to them periodically during the life of the debt capital will be more or less on par with the prevailing interest rate in the market. So whatever is the rate which is prevailing in the market, as on par or more or less to that value, the interest rate is decided and that is offered on the debt capital. Another important point what we have to remember is there is a maturity period for debt capital, which means that there is a life for debt capital. At the end of life of the debt capital, the total amount will be paid back to the total amount will be paid back to the debt holders. So it has to be redeemed, it has to be paid back to the debt holders. Then coming to equity holders, no maturity. So as long as the company exists, the amount of capital lies with the company. It is there with the company. The company has absolutely no obligation to pay it back to the equity holders. So the interest rate which is decided as on the date of issue of debt capital, it is more or less on par with the prevailing market rate, prevailing interest rate, and the same rate is applicable throughout the life of the debt capital. So it is a fixed rate. Let's say if it is the prevailing interest rate is 5% as on the date of issue, and if the let's say the life of the debt capital is 10 years, for a period of 10 years. Yes, yes, Harris.
Ma'am, my doubt is that from home perspective, we are discussing these points like cost is low and high from stakeholder
Hmm.
perspective.
Company's point of view, because company would be paying the amount to the investors. So whether it is debt
Ma'am,
holders or the equity holders. So from the company's point of view, we are discussing. Yes.
ma'am, but this risk factor, like risk is high. From the company's perspective, risk is high,
Yes.
or from
Yes.
stakeholders?
No, stakeholders risk is low. When we come to that point, I will definitely touch upon why is the risk high. So all what we are discussing is from company's point of view. The reason is we are looking at what is the finance function of a company. So the amounts are raised, the finances are raised, invested in a company. And how would the company invest in, what are the things in which it would be investing is also what we are going to look into that. So here, these finances are raised and invested in the company. So from company's point of view, what is the financial management function in a company is what we are looking at. I still have no,
Okay, ma'am.
haven't explained about the risk aspect. I just made a mention of it. We are still discussing about what is the cost. After we finish with the cost, then we come to what is the risk, right? So in
Okay, ma'am.
connection to cost, I am explaining about what are the returns and the maturity aspect of it. So once we finish with the cost part, we'll come to the risk. Okay. So if the prevailing interest rate is 5%, so let's say that they also have decided to issue the debt capital at 5%. Okay, at 5% if it is issued, and let's take the life to be as 10 years. For example, if the life is 10 years, it could be anything, 3 years, 5 years, 10 years, or any number of years for which the debt amount period can be decided. Okay. So let's say, for example, 10 years. So if they have issued the debt capital at 5%, the same 5% holds good for the next 10 years. It's a fixed percentage. Irrespective of what is the profitability position of the company, this rate of interest which is decided at the time of issue will hold good till the till the end of the maturity period. So until the debt capital is redeemed, they are entitled, the outsiders or the investors are entitled at the same percentage. So when we see that as the time passes by, the interest rate varies, when even when it rises in the market also, it would not rise in for the company. The company will continue to pay the interest amount at the decided, pre-decided fixed interest rate. On that note, we see that the cost of capital is low for debt capital. So cost is low for debt capital. Okay. On that same note, if we are talking about the risk involved in debt capital, after I discuss this, I'll go to equity part of it. On that note, the risk is high. What we are talking about is risk is high. If risk is high, why are we calling it as risk is high? See, there are two things. One is they are entitled to a fixed percentage of interest, is the first point of it. The second part is there is a maturity period. The first one, interest has to be paid irrespective of profitability. So even in situations where there are losses, where there are no funds available, in spite of that, because it is an obligation, interest amount has to be paid. So if there are no available funds, they have to raise additional capital so that they can meet this obligation. They are protected under bond, a covenant. There is a obligation, a covenant which is signed, duly signed, and there are the terms and conditions are there. We will discuss when we come to that debt capital in detail. So um, I mean, in case if the company does not pay that, it has to face certain consequences as well. So in that case, it becomes a obligation to meet that no matter what is the condition with the company. So that rises the risk for the company. So if there are no funds available, what has the company to do? The company has to borrow it from outside sources. So that again will increase their cost of capital. So here we see that first aspect of risk is interest is an obligation. Second aspect of it, since there is a maturity period, see, no matter how long is the maturity period is, but still at the end of the maturity period, the amount has to be paid back to the debt holders. Funds which are raised by the company are invested in the company in various uh, for various purposes. Maybe assets are purchased, some amount is invested in some other securities, projects, proposals, all these things, amounts are invested. They are not available in the form of cash, that anytime when they have to pay back that amount, it can be made. So the funds are blocked in various things, assets, investments, projects, and all. Amounts are blocked. So the maturity date, as on the maturity date, again the company has to find sources to raise the capital so that the debt capital can be redeemed. On this, on these two notes, we see that the risk is always high. So situations where there are losses also, interest has to be paid. So that rises the risk of the company. So debt capital is cheaper form of capital and riskier form of capital. These are the two attributes what we can talk about in case of debt capital. If it is equity capital, the cost is high and the risk is low. Risk is low is dividend is paid only when profits are available. There is no maturity period. So these 2 points talk about the risk part of equity capital. The risk is low. No dividends have to be paid, no maturity period, no dividends in case profits are not available. In case of profits are available, also the entire amount has to be paid is not the condition in case of dividends. So I'll discuss about that also. So the risk is low in case of equity, but the cost is high. The cost is high is, now we are saying that no obligation to pay that, no dividends have to be paid, no obligation. Only when there are profits, they are entitled to receive a dividend amount. The equity holders, the company is supposed to pay the dividend only when there are profits available. That is all fine. So that aspect talks about the risk as very low. But yet at the same time, on a contradicting note, we are saying that the cost is very high. What does it mean? See, even if there is no obligation, if the shareholders are not satisfied, when are they dissatisfied? When the company does not make any dividend payment, when the profits earned are very less, less profits are available for dividend payment. When such a situation happens, in that case, that causes dissatisfaction among the shareholders, the equity holders, the shareholders, the owners. It causes some kind of dissatisfaction. If they are dissatisfied with the position of the company, in that case, there is a chance that they can withdraw their investment. How does it happen? Then when there is no maturity period, will the company pay? No, the company would not pay, but the shareholders can sell their shares in the stock market and withdraw their investment. Okay, so that is the situation which happens when the shareholders are dissatisfied with the company, and dissatisfaction arises because they are not paid proper amount of dividends. Technically no obligation is there, but yet to satisfy the shareholders is the primary objective of the owner, of the management of the company. The company is under obligation which is not in return form, but the dissatisfaction which is caused to the owners on account of non-payment of dividend or less payment of dividend can result in they withdrawing their investment. So what happens if they withdraw their investment? So we see that if X sells away his shares to Y, Why is there to continue with the business, isn't it? So someone or the other will become the shareholders of the company. The point is, if more number of shareholders come forward to sell away their shares, then when that selling pattern or that selling trend picks up in the stock market, then we see that the prices of the shares fall in the stock market. Okay, the technicality we will discuss some other time. The prices of the shares fall in the stock market, so that will have an adverse impact on the company. So you must have heard in the news and all, business news and all, some of the days some companies do not make well, and then we see that certain points, there is a fall in certain points of that company. Some companies gain the points and all, they are well through, they are doing well in the stock market, so that is an indication there. So that should not, now if that is the message which is carried out to the other stakeholders, the other stakeholders also may withdraw their relationship with the company, suppliers, customers, general public, government, trade unions. There are various stakeholders. So that also can have an impact on other stakeholders. So non-payment of dividends to equity holders, okay, can cost the company indirectly. Okay, that cost the company in terms of the performance in the stock market getting affected. For that reason, the company is always under an obligation to earn high profits for the company. Satisfying the shareholders is the important aspect or the goal of the organizations, to the company to see that the shareholders are satisfied. When are they satisfied? When high profits are earned and high dividends are paid. So to keep them satisfied, high cost of high cost of capital in the form of dividends have to be paid to the equity holders. So on that note, we see that cost of capital is high in case of equity. Okay, risk is low in case of equity. Technically, they are not under an obligation, but yes, they always see that danger if they do not pay the dividend. So cost is high and risk is low in case of equity capital. So we have to understand that how much of each type of capital should be invested in the company. So when there are two different types of capital, ideally speaking, they should be invested in the ratio of 1 is to 1. Debt capital 1, equity capital 1. So in the ratio of 1 is to 1, these capitals have to be invested in the business. So the important point about the finance function, we see that there are two different types of capital, the debt capital and equity capital. These finances are collected, they are invested in the company into various things. Okay, so the financing decision talks about what are the various sources of capital. The various sources of capital are debt capital and equity capital. The cost of capital, very briefly, we have discussed about what is the cost of capital. Intricately, we have to look into what is the cost of capital. The cost of capital is low in case of debt capital, high in case of equity capital. The capital structure, the ideal capital structure about the business is both of them should be equally invested in the business. So money in the ratio of 1 is to 1, the amounts of capital, debt capital and equity capital have to be invested. And the risk aspect is debt has high risk and equity has low risk. So that's the brief understanding about these two different types of capital. So once the finances are raised, they are invested in the company. In what are they invested? They are invested, the finances which are raised are invested into, we see the investment decision now coming. So they are invested into, the first aspect is we see that working capital. Then we see there is investment in non-current assets. So I'll explain what is the meaning of non-current assets. So they are invested in non-current assets, and then we see that the dividend part of it. So dividend is one specific decision, very important, crucial decision for a company. So the amounts which are raised are invested in working capital. Any one of you have any idea about what is the meaning of working capital?
Ma'am, may I?
Yeah, sure.
Ma'am, working capital is the capital that a business require for the day-to-day in day-to-day course of business.
Very good. Okay. For the day-to-day activities, whatever is the requirement of capital which is invested, we call it as working capital. Good. Okay. So under investment decisions, the investment decisions are related to investing the amount into both the long term and the short term. So um, if this is a balance sheet, the condensed form of balance sheet, we see that on the asset side, there are two different types of assets, very broad classification. We have current assets, which are also called as short-term assets. Then the next type of assets, we have it as fixed assets. On the liability side, there are three different types of liabilities. One for the short run, then the other two are the long-term liabilities. So we call them as long-term liabilities as well as equity. So long-term liabilities, another name for long-term liabilities is debt capital, what we have learned just now. Okay, that is debt capital plus equity capital. So these two are for the long period of time, long-term. Okay, so when we group them, when we group these assets and liabilities, one part of grouping is we find out what is the amount of working capital by grouping current assets and current liabilities. Current assets are short-term assets, current liabilities are also short-term liabilities. Okay. Then another type of finding out what is the working capital is by grouping the long-term assets versus the long-term liabilities. So both of them, long-term liabilities and debt and the equity capital together, and is compared with the long-term assets, which we also call them as fixed assets. Fine. So how much of the amount should be invested in short-term assets? How much of the amount should be invested in the long-term assets is one very important decision. Then we've also discussed just now about how much of debt capital and how much of equity capital should be raised. Ideally speaking, it should be in the ratio 1:1. So debt capital and equity capital should be raised as 1:1. Current liabilities are also a part of liabilities only. They are also outsiders extending credit to the business. Fine. The investment decision should be, okay, how much should be invested in short-term assets, how much should be invested in long-term assets. So that is one important point. So the decision related to investing in short-term assets or current assets and the investment into long-term assets or fixed assets. So that is one important criteria. What is the proportion in which the current assets are the investments are made into current assets and the investments are made into fixed assets. Roughly, I'll just talk about simple points. The return which can be earned from fixed assets is higher than the return which is earned from the current assets. So, how much should be invested in current assets, how much should be invested in fixed assets is a decision which has to be taken based on the return aspect of it. Why are we calling it as short-term assets or current assets? We understand that these assets can be quickly converted into cash. Short-term assets, the time is a short period of time. So at the end of the short period of time, these assets can be converted into cash. So they enable the company to meet the cash obligation. So whatever are the payments which have to be made, once these assets are converted into cash, this cash is used to invest in to clear off the short term liabilities. So current assets are used to clear off the current liabilities and also to meet the day to day expenses. Day to day activities also can be met with the current assets. So return part of it is low, but current assets enable something. They enable the payment or the discharging of the current liabilities on the due date. Plus, they also help in running or meeting the operating expenses, day-to-day activities of the business. The expenses can be paid out of current assets. So there is a decision related to current assets versus fixed assets. Done. Then current liabilities and long-term liabilities. Current liabilities and long-term liabilities. The cost of the cost part of it, when we look into, see there is a term period which is linked to each type of liability. So current liability, they have to be paid in a short period of time. So short period of time, they have to be paid by the company. So too much of current liabilities, if they raise, short-term liabilities, if they raise, then they may not have sufficient amount of cash funds available to meet the liabilities. Okay. Then long-term liabilities, some of them have to be paid in the long period of time. Some of them have not to be paid at all in the uh, during the life of the company. But then the cost aspect also we've looked into, something which is very high, cost of equity is high, cost of debt capital is low. Okay, so then looking at the cost aspect, then again we have to decide on what is the proportion of current liabilities which will be raised, the proportion of long term liabilities, the proportion of equity capital. So how these things would be raised and invested in the business is what we have to look into. So working capital, one equation of working capital is the capital which is available by converting current assets into cash and meeting the current liabilities. So one equation of working capital says current assets minus current liabilities is what is working capital. Another equation of working capital is also, so the first equation we are mentioning that current assets would be higher than the current liabilities. So this side, this part of it, so this is high and this is low, current liabilities is low, but both the sides all the time balance. We know that balance sheet on both the sides balance. So if it is high, this would be low, and if this is low and this part of it, the long term liabilities part of it, will be high. So the other way of finding out what is the working capital is the debt capital plus equity capital. The long term liabilities plus the equity capital is now this time higher than the long-term assets. So debt capital plus equity capital minus the fixed assets is also called as working capital. Okay, so the investment decision is very important here to understand how much should be invested in current assets so that this current asset can help in making the payment of current liabilities plus the operating expenses. The fixed assets, the return is high as compared to the return on current assets. So the profitability which can be earned or generated from the use of fixed assets is higher than the use of current assets. So more amount of fixed assets can be invested in, but to convert them back into cash is very difficult in case of fixed assets. So technically, some of the times it is not possible at all to convert them back into cash, but they can be used in the business. As long as they are used in the business, there is a return which can be earned from the fixed assets. Then long-term liabilities, we see that the cost aspect of it, of the long-term liability, and the maturity part of the long-term liabilities, and the equity capital versus the current liabilities. So current liabilities are less. Now, keeping them at a lower level enables them to meet them on the due date. Too much of current liabilities put the business at risk because if they cannot make the payment on the due date on account of non-availability of cash, reputation of the business gets affected. So there is a risk aspect involved there if the current liabilities are not paid on due date. Okay, so this is the proportion of the current assets, fixed assets, current liabilities, long-term liabilities, in which the amounts have to be invested. So the working capital part of it takes care of the short-term position as well as the long-term position. So the next topic after this particular thing, what we are going to take up is investment appraisal. So in detail, we are going to look into how are decisions taken, whether or not to invest in a particular asset. So that we are going to look at investment appraisal. Then in detail, we're going to study about working capital management, because under working capital management, we need to understand what are the various types of assets, various types of liabilities, um, various terms and conditions associated with that we are going to learn. Okay, and the risk which is involved in these investments. Okay, coming to non-current assets are fixed assets. So you understand that non-current assets are fixed assets. Then we have the next part of the management function, which is the payment of dividend. Payment of dividend decision is so whether the dividend is paid or not. Simple terms, I have mentioned that if the dividend payment is not made to the shareholders, it can have an impact on the performance of the shares in the stock market. So the business valuation gets impacted on account of the dividend decisions. So whether dividend is paid or not definitely shows uh, an impact in the stock market. Fine. Then there are theories we have to learn in connection to the market performance, efficient markets, how the markets are there, and the theories which are associated with the market, stock markets, the dividend decisions, all of them are going to be covered under the category of dividend. So here, basically, the financial management function has three important decisions. The first one is the financing decision. What are the various types of finances which are to be raised and invested in the company? After the finances are raised, and what are the assets the finances are invested? So we understand the classification as short-term current assets or long-term fixed assets, and the sources are short-term liabilities, long-term liabilities, both from the outsiders and the owners. Okay, so how are they invested in short-term assets? How are they invested in long-term assets, non-current and non-current assets? And finally, the decision is about what decision do they take for dividend payment. So dividend decision impacts or has an impact on the business valuation, and then later on we're going to learn about what are the efficient markets and the theories associated with efficient markets. Any doubts still here?
No, ma'am.
No, ma'am.
So let's move ahead. So the financial management function, the first thing we have looked at as raising the finance, investing these finances, and then dividend policy. So by now you have already, you must have learned about what is the meaning of corporate strategy and objectives. What is strategy? What is strategy?
Ma'am, which by reviewing other organizations which are in competition with us and making our own path to follow.
Okay, the path to follow is the vision. Strategies, the anyone else? Yes, you're correct. But I want another answer. What do you understand by strategy?
Ma'am, when we combine different course of actions and uh, ma'am, there are many course of actions combined together
Okay.
makes a strategy.
So course of action is plan. In simple terms, we can put it strategy as a plan. plan for the organization which it has to achieve in the long period of time. So long period of time, many plans have to be combined to make it as a strategy which has to be achieved. So how would it achieve those plans or goals and objectives and targets is what is covered under corporate strategy. But then how are these plans prepared? There are various aspects which have to be considered about how the plans are or the strategy is framed for the organization, which eventually has to be achieved by the organization. The organization has to achieve that. It is not possible to achieve in the short run. Over a long period of time, what has to be achieved, which when it is defined and framed, we call that to be as a strategy. So it composes of many plans, like you have said, many courses of actions, or many plans are combined together to call it as a strategy. How is it framed? How is it decided and all? I don't know whether you've learned it, or definitely you would be learning that in this course of ACCA. So the first thing for an organization is the overall mission is decided. Overall mission is decided is the very basic purpose of its existence is defined. So why is the organization established? What is the basic purpose of its existence is the mission. So the overall mission is the first step which is decided. So once the mission is decided and the goals and objectives of the organization are defined, what has to be achieved, what has to be achieved so that the the purpose of its existence can be fulfilled. So the goals and the objectives, detailed objectives or targets are decided. These have to be achieved so that the purpose of the existence, the purpose of the organization can be fulfilled. So to achieve these goals and objectives or the targets, they require various course of actions or various plans are needed. That is for an organization. So organization, the goals and objectives are again classified as commercial and financial. So we are going to look at only the financial part of it. So the commercial and the financial. In an organization, the hierarchy of the organization has broadly three different levels. The one which is at the top level, so it's in the form of a pyramid. So at the top, at the pinnacle, we see the top management, the senior management, which is there at the top. Then we see the middle level management, and then we see that the operating level management are the ones who actually implement the plans. So the low level or the operational level, what we call it as. So this is the hierarchy of a organization. So this is the top level, also we call it as corporate level. So this is the top level, it's written here as corporate level, we see here. Then the middle level, this is the middle level, which is also called as the business level. Then the low level, which is also called as the operational level. So why are we looking at these three levels of management? The objectives can be broadly classified as commercial objectives and financial objectives. So we're going to touch on the financial part of it, but first we'll understand what is the role of these three different levels of management. At the top level, the top management focus is on, one second. Okay, the top management's role is to plan for the organization as a whole. The organization as a whole, what will the organization achieve? What will the organization take up? What will it do as a whole? So it is not deciding for each unit of the organization. It is for the entire organization as a whole. The organization, what would it achieve is what is decided or planned by the top management, the corporate level. Okay, so what do they plan? They plan about uh, the organization, what are the products and services which it would produce, what are the markets in which these products or services will be sold. So the company as a whole, what will it do is what is planned, decided by the corporate level, the top management, the senior management decides about what are the markets into which um, they will venture into and then sell the products and services. So the planning related to those things as as a whole, as an organization as a whole, is decided by the corporate level. Okay, that is for the commercial part of it. Then for the financial part of it, how much of ROCE is return on capital employed. Return on capital employed, what is the earnings per share? What is the value of the share, the share price, the issues related to that will be focused by the corporate level because they are looking at a broader level. So their scope is to to look at the organization as one unit, which they will be projecting this unit in the outside market, in the external environment. They are going to place this one. So when they are placing that in the external environment, in which markets will they venture into, with what products and services will they venture into. So they have a target or an objective of earning a overall return on the total amount of capital employed or the earnings per share or the performance in the stock market. So those things are the criteria which are considered by the top management. Then coming to the middle level, what is the role of middle level management? Middle level management, now see, overall planning is done by the top management, but to achieve those targets, the targets which are decided, the targets, let's say that if they have a target of earning a profit, that is ROCE of let's say 10%. So to earn that 10%, mere deciding of a target or an objective is not sufficient. It has to be worked out, it has to be planned how they are going to do. So where they are going to venture into, what products they are going to produce is decided by the top management. But how will they produce that? How will they ensure that these products are made available to be sold in the external environment? So planning, how part of it will be planned by the middle level management. They are going to look into what has to be taken up so that they can achieve the overall strategy, overall objectives of the organizations. That's the role of middle level. So they are going to look into to take up the activities, what are the things which are acquire and equip new premises, and then they decide on for each level within the organization, each department wise, function wise, unit wise. So they set targets for them. So that is how when they work together, it becomes possible for them to fulfill their um, achieve their targets and meet their goals and objectives. So once the objectives are decided, the planning part of it has to take care of how um, what they're going to do for the overall, how they're going to do within the organization at the middle level. So they have to decide on what individually each department or function or unit will be doing that. So they set targets for each department. That's the role of middle level management. Then the low level management are the ones who implement. They are the ones who are involved in implementing the plans which are prepared by the middle level management. So the plans, whatever are decided, the individual targets, each department, each unit, each specialization. So they are more focused on um, meeting their targets, achieving their targets. Somebody is working in tax department, so their focus is only related to the tax part of it. So with that specialized knowledge of tax, they implement the targets which are decided for tax department. Somebody with working with the receivables department, they are more involved in achieving the targets about the receivables. So somebody with law department, mortgage department, credit department, purchases department, sales department. So individually, their focus is about achieving their targets, to see that their day-to-day activities are carried carried on smoothly. That is at the operational level, the low level, operational level, the specialized level, expert level. All these things are the names which are given for the operational level. So they are more involved in achieving their targets, which are set up uh, to ensure that they can meet their targets and fulfill the objectives of the organization. So in case of commercial, they maintain liquidity levels, so ensure that sufficient amount of cash is all the time available to meet their requirements in terms of making payment to the outsiders, and also to make their payment for day to day activities. Okay, so the financial part of it also, they are more concerned about the cash levels, the receivables and all. What are the strategies to, so if we are talking about the goals and objectives broadly classified as commercial and financial, if these are the things which have to be achieved, if these are the plans which are prepared by each level and implementation is taken care of it, to to meet these objectives, there should be supporting course of action, supporting plan has to be made available. So at the top level, to achieve these overall mission, would they go on an incremental basis? Incremental basis is grow gradually year after year. So first year, if they have achieved a target of some X number of units sold, the next period maybe another 10% increase. Then coming year again another 10%. So that is step by step, slow and steady, incremental, organic growth. So
Excuse me,
there
ma'am.
is no rush, there is no achievement of these objectives overnight, but they focus on achieving on an organic manner, in an organic manner, incremental manner. That is the growth. So at
Excuse
the
me,
top,
ma'am.
yes, yes, yes.
Ma'am, I didn't get the difference between the corporate level and the business level.
Corporate level is the
Level makes
um,
us the
they
savings.
plan for the organization as a whole. Their planning is organization, the entire organization as a whole. So what will the organization as a whole do? So what are the products and services which it will produce and sell, and in what are the markets where they would be selling that? That is decided. So XYZ Limited will produce these products and sell them is decided by them, and for that they decide overall objectives about how much profit margin, ROC, EPS, the performance of, okay, as a whole. Now if the products have to be produced, let's say that they are planning to produce products 1, 2 and 3. Now how will they produce? What are the resources needed? Who would produce? What are the departments which are involved? So production 1, 2, 3, three units are involved in producing. Some other department takes care of the material purchase, a labor department. So how should they work so that they meet the target of deciding on what are these products 1, 2, 3 which will be produced and sold. So internally that planning which is taken up, internal planning. Externally they are placing them by the corporate level. Internally, to meet those targets which are decided for the organization, internal planning which is taken up, okay, for each unit, each department, each function of the business, that planning. See, if product 1, 2, 3 has to be produced, what are the activities which are involved, what are the functions which are involved? Production has to take up, production department has to produce, then purchases department has to purchase, then HR department has to take care of the staff which have to be appointed and I mean recruited and placed in the their works. Then the administration work of it, then selling and distribution. So we see that there are other functions as other functions which are needed, so that the target of meeting these products, production of these products and sale of this can be met. This is at the corporate level, they have decided something like that. But to meet this, to see that, to ensure that these products are produced, there are so many activities or functions which are needed to work. So the planning which is taken up by for all these things in the organization is taken up by the business level. So internal planning is taken up by the business level. So to ensure that they are able to produce the products and services and expand into markets and sell into markets and all, to ensure that happens, there should be a work at the ground level also. So there should be planning at the ground level and implementation at the ground level. So the planning part of it is taken care by the business level. Implementation part of it is taken by the operational level. Any better?
Yes, ma'am.
Anyone else has a doubt? Okay. Uh, so organic growth and acquisition. So the strategy could be about how would they grow. See, the mission cannot be achieved in a short period of time. It has to be achieved over a long period of time. The very basic purpose of the organization cannot be achieved instantly in a short period of time. It has to be over a long period of time. So during this long period of time, how would they aim to achieve this objective? Is it in an organic manner? Organic manner is slow and steady growth year after year. Okay, every year a percentage of growth is expected, planned, and achieved is organic fashion. They can also grow by taking a jump. That is, they can acquire another business which is already existing in the market, acquire the business, and expand their business. So acquiring a business is investing the amount in another business and becoming a parent company of that business. So how does it work out? If there is another company, if they can manage to get buy shares of that company, if they can buy more than 50% of the company, okay, then they can become the parent company or the acquirer company of the other company. The other company is called as target company, and this company will become the acquirer company, or eventually it becomes the parent company. So they can control the other company, and they take up the responsibility of the other company as well along with their company. So their business grows in size. So that is a dynamic step. That is that involves huge funds, that involves risk, all that. So that is again a way in which growth is possible by acquiring another business. Acquiring another business is acquiring more than 50% of shares of an other company. Acquisition. So they can grow on a steady manner year after year by increasing the growth percentage by a specific percentage and growing according to that. That is gradual, organic in nature. Another thing which is dynamic in nature and which can happen in a short period of time. Growth can be drastic, dynamic. um, when they can acquire another business, invest amount into another business, finances, acquisition happens. Okay, of course there are issues with the acquisition. Funds are needed, risk is there. They may become successful in managing the other business, or they may become a failure. So those risks are also there, but that is an alternative available there as compared to organic. Then when assets have to be purchased, that is at the business level, when they are deciding for the business internally, what is that they have to, what course of action they have to take up. So in terms of what are the assets which have to be purchased, assets, whether they can be the decision is about either they can be purchased by the assets, or assets can be taken on lease. Lease is acquiring a right to use the asset without purchasing the asset. Lease. So some other time we are going to look into the details about lease. So right now, so the decision can be about buying the asset or acquiring the right to use the asset in the business, that is lease. Okay, so lease or buy. And then finally, the operational level, the strategy will be about whether they should sell the goods on credit basis or cash basis. They have to buy the material on credit basis or cash basis. What is the credit period extended to the customers? What is the credit period availed from various stakeholders, that is from the suppliers, from the other stakeholders like employees, whether the payments are made on due date or anything which is on credit basis outstanding. All those decisions on implementation level about the credit part and the cash part of it is planned at the operational level. So that is at the implementation level. So there are certain things which are decided. So the corporate strategy and objectives, we have looked at what is the hierarchy, the three different levels of management, what is their role, what is their role for the commercial aspect and the financial aspect. So we are going to, throughout this paper, we are going to focus only on the financial part of it, commercial part of it, because it's part of this particular hierarchy. I just explained to you, but we are not going to do anything in detail. The focus is only on the financial goals. So we're going to look at the financial goals only during this particular paper. So the ROCE, the EPS, share performance, the project returns, the working capital requirement, that is the cash and the credit levels and all those things we are going to look into that. Okay, have a look at who are these stakeholders of a company. The corporate stakeholders. Stakeholders are anyone whose interest is there in the company. They have vested their interest in the company. A stakeholder group is one with a vested interest in the company. First one we see among the stakeholders. The first one is shareholders who contribute their capital to the in the company. They invest their amount in the company. They contribute their capital to the company. The other stakeholders are, we see the customers, the suppliers, the employees, the management who runs the business. The other stakeholders are the society, the community, the government, environmental groups, trade associations, unions. General public also has some interest invested in the company. They want to understand how are they performing, what is their role. Okay, environment groups are interested to understand what is the impact of the business activities on the environment. What are the resources which are used by the company? What is the carbon footprint? What is the impact of pollution which is generated by this company? All that is interested is the interest of the environmental group. So they also look at whether the company is complying with what rules are decided for the company by the government. Government is interested to understand about what is the profit which is made by them and what are the taxes which have to be levied on the profits which are earned by the company. Whether or not they are complying with all the rules and regulations. So the regulatory bodies, like in India we have SEBI, then each country we see that there is a regulatory body giving the I mean mentioning the rules and regulations. They also have to be complied. The company has to comply with all the rules and regulations. The customers are interested to understand the affairs of the business, to understand whether measures are taken to cut down on the cost, whether control measures are taken, whether the company is making undue profit at the cost of the customers, and high prices are charged, or measures are taken to cut down on the cost and the prices are reasonable. Suppliers are interested to understand about what are the requirements of material which is needed by the company, so that they can supply the material according to the requirements. The community also wants to understand about what is the company, the profitability of the company, what are the resources which are used by the company which belong to the society, so the natural resources which are consumed. So um, and in return, is there anything which the company does for the community, that is corporate social responsibility, what we call it as. So we see there are so many stakeholders whose interest is vested in the company. We're going to touch upon under each part of it what is their interest. So from time to time we are also going to touch upon the impact it would have on stakeholders. Okay. The next one, we see the agency theory. So when we started with the point that so there is a company which is established. The company is established by the amount which is invested by the owners. Now here in case of a company, we see that owners are the shareholders. A company is established by the owners by when they invest their amount in the business. But owners do not run the business. They do not take the decisions. They do not manage the day-to-day affairs of the company. Who does that then? It is only that they invest their amount and their interest is only in terms of earning a return in the form of dividend. So the owner's interest is only towards the return which has to be earned. So this company is managed by the management. Management runs the affairs of the business. So the company's affairs, management. The company's affairs are run by the management. So the role of management, or the capacity in which they are taking decisions on behalf of the owners is in the relationship of an agent. So the management acts as agents on behalf of the owners to run the company and earn profits for the shareholders. Okay, agency relationships occur when one party, the principal, employs another party, the agent. So the owners employ the management or the agents, okay, to perform a task on their behalf. So to earn the profits for them, they appoint the management. So they act in the capacity of agents. So they act as agents, manage the affairs of the company, make profits which belong to the owners. So owners um, appoint these agents on their behalf to run the affairs of the company so that their profits are maximized. Objectives of the principals and agents may not coincide. Okay, so what is expected of the owners? Some things which we are going to look into is what is the expectation of the owners may not be achieved by the management. So when they are taking decisions, they may not always go on par with whatever is expected by the owners. So there can be some kind of a dysfunctional behavior on part of the um, agents or the management. So it says that objectives of principals and agents may not coincide, may not be on par. Okay, then all of them should work towards the achievement of the organization goal. Organization goals, we've seen that the organization, after the um, overall mission is decided, the goals and objectives are decided. So everybody in the organization should work towards the achievement of the same goal. Okay, if that is not the case, then there will be some um, disagreement, and it would not be called as they are working towards the same goal. When everybody works towards the achievement of the same goal, everybody understands the goals of the organization in the same sense, everybody works towards the achievement of the same goal. That is called as goal congruence. Okay, when their objectives do not coincide, then there is a problem of goal congruence. So management may want to run the business according to their style of working, their pattern. Owners may expect something else from the company. So when they do not coincide, then we see that there is a problem of goal congruence arising. But everybody should understand it is the objectives of the organization which are important, which is, it is not individual objectives which they decide for themselves. So everybody in the organization at every level, everyone, when they work towards the achievement of the organization objectives, we call it as goal congruence. Otherwise there is a problem of goal congruence. I know too much of theory today. I'll ensure that from the next class onwards, we also simultaneously work out on the questions from the examination kit. Just for today, you will have the theory part of it, which is delivered to you. But come prepared from tomorrow's class with a notebook and a pen so that we can work out the questions from the examination kit. One type of classification of organizations is organizations which are established to earn a profit. So they are called as profit organization. Organizations established to earn a profit, profit organization. Not all organizations aim to achieve profit, aim to earn profit. Okay, their objectives are not in terms of profit earning, right? There are organizations which are established to render services. Their aim is not to earn a profit. So if their objective is to render services, they are called as not-for-profit organizations, NFPs, not-for-profit organizations, NFPOs. Okay. If it is profit or objective, measuring the profit objective is very easy. So the financials are measured. What is the target? How much profit margin is their target? Whether or not they have achieved that target. If they have not achieved the target, if they have not earned that much profit, what was the reason? Reasons can be looked into. It can be rectified and ensure that they in the next period they can earn that profit. So measurement of performance in case of not for in case of profit organizations is easy because their performance is evaluated, measured in terms of what is the amount of profit made. But if it is a not for profit organization, profit is not their goal. So what is that they are looking at? So their objective is to render services. Services provided are limited by the funds available. So their objective is to see that they render services. Okay. So what are the key objectives for not-for-profit organizations? Key objectives for them is how would they generate the funds? They are established with an intention of rendering services. So anything which is spent, the cost which is spent, they will not get it back because they are not into sales, they are not into making profit. So even if they sell also, it would be at a very minimum price, so there is no profit available that they can plow back into the firm and then continue with that. So funds are not available, sufficient funds are not available, raising of funds is an issue. Initially, when they are established, the funds which are raised are invested into the activities of the organization. So they are busy in achieving the organization objectives. Okay. Since there is no objective to earn back, then it says that services provided are limited by the funds available. Why limited by the funds available? Because they are not earning back their profits that they can reinvest in the business and learn that. So there is a constraint here. There is a limitation. They are limited by the funds which are available. So key objectives for not-for-profit organization is raise as large as sum as possible, then spend funds as effectively as possible. So the first part of it is how would they raise the funds? That is an important thing because they're not getting back anything in terms of sales and profit, revenue and profit. They have to depend on what are the sources from which these funds can be raised. That's one thing. Second one, once the funds are raised, whether or not they are using them effectively. That is again another part of it. So they also have to take measures to cut down on their costs, economize on their cost, spend them wisely, uh, take all possible measures to cut down the costs. So those are the two important aspects in terms of the financial part of it. This is financial management. So we are not going to into the other intricacies of not-for-profit organization. How is their performance measured? How are they going to achieve their objectives? All that we are not looking into. We are looking at only from the finance part of it. So from the finance, from the focus of financial management, we understand that the issues are to raise as large as sum as possible. First thing. Second one is spend funds as effectively as possible. So wherever possible, they should cut down on the cost. So now there is no accountability in terms of earning a profit. So they are not looking at making a profit. At the same time, they should also not spend unnecessary funds when it is not needed. So measures have to be taken to cut down on the cost. That is the second part, second important part. Spend funds as effectively as possible. Okay. What are the targets? The targets set per period. Targets are set per period. Total to be raised in grants and voluntary income. So generally, how do they get their funds? From charity, donations, grants, and people contributing the amount to them. So that is the main source from which they can raise their funds. Total to be raised in grants and voluntary income. Maximum percentage of this total that fundraising expenses represents. So on what are the things which they are spending? That's the second point of it. Amounts to be spent on specified projects in particular areas. Maximum permitted administration costs, meeting budgets, break even, other measures, waiting time, successful outcomes, etc. So how are they going to spend their amounts is important. Then they also have these targets which are decided. So comparison of actuals with the targets, control action taken if necessary. So in connection to the not-for-profit organization, how is the performance measured for not-for-profit organization is given as see, for a profit organization, easy to measure the performance. Profit target, whether they achieved or not, what is their profit target, what is the cost, what is the revenue, how did they earn that? Sorry. How did they earn that profit? All that is looked into. Um, so the value for money is no, for a profit organization, they measure that in terms of whether they have earned the profit or not. But for a not-for-profit organization, profit is not there. So how is the what are the parameters which are considered? So the parameters which are considered are given as three E's. They're measured in terms of three different E's. The first E is economy, whether they are taking measures to cut down on the cost. So just because profit is not assessed or calculated, or evaluation is not based on profit, it doesn't mean that they spend as much cost as and where, but they should take measures to cut down on the cost. So being effective and efficient at the lowest possible cost. Okay, that's the first E, economy. Then the cost which is spent, the inputs which are used or spent with an intention to earn a specific objective. So as much as they are spending, are they getting anything in return is what is measured. Measure of outputs over inputs. Measure of outputs over inputs talks about efficiency. So as much as they are spending, are they getting anything in return is about the efficiency. When they focus on economy and efficiency, both of them, for the amount which they are spending, after taking all possible measures to cut down on their cost, the amount which they are spending, are they getting the output in return? Both of them are looked into. They are effective overall. So measure of outputs, also considering the cost part of it, is effective. So they should cut down on their costs. They should measure their performance, inputs and outputs. Both of them together, they are called as being effectiveness. Okay, so that's how the not-for-profit organizations are. Their performance is measured.
Excuse me, ma'am.
Yes, yes, ma'am.
Please explain that example, average class size. Ma'am, previous slide.
Yes, yes, yes. Effectiveness is given. I mean, there is one example which runs through all these three E's. Okay, so number of pupils taught. Okay, so if teaching them is the objective, number of pupils taught. Okay, so the economy is in terms of the amount which is spent on these students. When they are spending the cost, various things for which the amounts would be spent, like purchasing textbooks and the various other resources, material and all, that should be taken up at minimizing the cost, not compromising on the quality. Yes, but uh, selecting the right supplier, purchasing it from the right sources where the cost is at its lowest. So that is economy. So purchasing the textbooks and the other resources, spending on other things which are needed by the students, all that, but not spending as they like, or not taking care of about what is the cost which they're spending. So uh, ensuring that the best quality at the lowest price. So that is economizing one. Then um, efficiency, it talks about what is the output versus input. Okay, so all these students have to be their performance has to be measured in terms of what is the output which is generated. All of them are put in one class and then they teach them or take up that, maybe they that is not efficient. So they decide on um, dividing them into groups and getting the output out of them. All of them are dumped into one class and one section, and then it is the content is delivered to them. The output will not be as effective as if they are made into small groups. So deciding on the average size, measurement of the performance, the input and the output. So what is the output, the performance of the student, that is much better when they're divided into smaller classes, smaller sizes, and the content is delivered to them when taking care of that size. So measurement of performance is important. Efficiency, when all the things are taken care, then they are effective for the total class of students for which the teaching is taken up. The overall performance, the final output from the students in terms of spending less cost or economizing on the cost. It is not compromising on any part of it, but taking measures to mm, uh, cut down on the cost by selecting the right supplier, the right material, it may availing discounts and all those things. That is minimizing or economizing on the cost. Then measuring the output. Okay, measuring the output as much as input is given, is there any output from them, and overall taking care of all of them is the effective.
Can we relate these three terms to like quantity, quality, and the cost? Like
um
effect,
done. Yeah,
quantity, and
that is another. I know that is a very well presented quantity, quality, and the cost. Yes, 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 very well presented. Okay. So system analysis, what are the inputs, what are the processes, what's the output, and the overall outcome. So value for money focus on the cost and cost control is economy. System and methods efficiency. Systems and methods is the efficiency. The overall thing is effectiveness, achieving the targets. So the inputs are in terms of material, staff, the cash, whatever is spent, inputted. Okay, that is inputs. Then processes talk about interaction of people, structure, information, and task requirements. Outputs are in terms of goods and services. When they meet their overall objectives, is the effectiveness. Okay, if that is clear till here, um, what is the financial management function?
yes, ma'am.
Then we can think about investment appraisal. The investment appraisal will be um, getting into a new topic, new area, and then taking it up. So, any doubts till here? Okay, is there any class rep in this group? Someone who will make a note of the attendance or other details or communicating with the faculty and all? Any CR or class rep or anyone?
Yes, ma'am.
Yeah,
I'm the class representative.
Ashley. Okay. Okay. Anything you keep in touch with me, communicate with me from time to time. Mm, so 20, you said 20 is the strength and 50% of them are attending. Okay. Which semester are you in? Which program and which semester?
Ma'am, there are two batches in this for this training. The first batch is our 2019 batch, that is uh, that is a semester 4 students, and there are some other students who are our seniors that are from semester 6.
Oh, okay.
Yes.
How come semester 6 students have not finished FM till now? Okay. So this is BCom program? BCom,
Yes.
BBA, BCom. Okay. see, we have the examination kit. Displayed on the screen. The rest of the time, instead of I going to the we going to the next topic, the investment appraisal. Let's go through a few questions from the examination kit. The first one is, in relation to financial management of a company, which of the following provides the best definition of a firm's primary financial objective?
Ma'am, I think answer C, to maximize the wealth of its ordinary
So
shareholders.
wealth of its shareholder,
Yes,
ordinary
ma'am.
shareholders. Um, okay, we've discussed that there are broadly two different types of share cap. Two different types of capital. One is debt capital, one is equity capital. But then again, I said equity is a broader term. Under that, there are other types of capital as well. So again, under equity, we subclassify them as one type of capital. We call that as preferred capital, preferred share capital. The other one is without any preference, also called as ordinary or common shareholders. So we call them as, okay. When we look into this classification, when we are dividing them into preferred and ordinary shareholders, preferred shareholders, because there is a preference, the name itself says that there is a preference. So preferred shareholders have a preference in terms of dividend payment. So first, the when the company generates revenue, that is sales revenue, from sales revenue costs are deducted and profit which is earned. So this profit belongs to all the investors who are outsiders, debt holders, investors who are owners, which are shareholders. So first preference is given to outsiders. Outsiders, their interest is paid because it's an obligation. We've already looked into the explanation. Their amount is paid first. So interest is paid, then tax is paid. The rest of the profits belong to the shareholders, both the types of shareholders, preferred shareholders and ordinary shareholders. So as the name says, they have a preference in terms of dividend payment. Their dividend amount is also at a fixed percentage. So the fixed percentage of dividend is decided at the time of issue of preferred share capital, preference share capital, what we call it as. So that is decided at the time of issue. Then if there is anything available, remaining amount of profit, the entire thing belongs to the ordinary shareholders. It is only at the time of dividend payment that we see that there is a preference to the preferred shareholders, preference shareholders. There is no preference, but the remaining amount of profits, the entire amount of profits belong to the ordinary shareholders. Plus, these people, ordinary shareholders, can participate in the decision making. They have something called as voting rights which are available to the ordinary shareholders. So they also participate in decision making. From time to time, when decisions have to be taken, they participate in these meetings and they use their voting rights to vote for a particular decision. So they also participate in decision making. So they are also called as the real owners of the company. Okay. We see the debt capital and preferred capital kind of similar because uh, interest rate is fixed, preferred dividend is also fixed, both of them are fixed. Okay, but debt capital has a time period, preferred capital doesn't have a time period, there is no maturity. Okay, um, on that note we see that they are kind of similar, yet there are distinctions between debt capital and preferred capital. Preferred capital belongs to the category of equity. Debt capital is outsiders fund. Preferred shareholders are owners. So there are certain other intricacies also. Sometime later we will look into that. So here, because the real owners are the ordinary shareholders, the maximization of wealth of the ordinary shareholders, ordinary or common, but that doesn't make them any ordinary. They are the real owners of the company because they have the voting rights and then they participate in decision making. They are called ordinary because they do not have the preference at the time of payment of dividend. Done? Okay. Next. The next question is indicate by clicking in the relevant boxes whether the following objectives in are financial or non-financial objectives of the company. Maximization of market share, earnings growth, sales revenue growth, achieving a target level of customer satisfaction, achieving a target level of return on capital employed. Which one is financial, which one is non-financial? Anything about non-financial, if you can look into that and then tell me.
It is achieving a large target level of customer satisfaction is non-financial.
Okay.
Maximization of market share is also non-financial.
One is market share is
Non-financial.
market share is how many customers are the regular customers of the business. So market share talks about the customer base. So this one is non-financial. Earnings growth is financial. Sales revenue growth is financial. Achieving a target level of customer satisfaction is non-financial because it's customer related. Return on capital employed is financial. Then the third one, which three of the following are the main types of decision facing the financial manager in a company? The three decisions are
Investment, dividend, and
Mm.
financing.
Yes, ma'am.
that's right, investment decision, dividend, and financing decisions. Which two of the following are examples of financial objectives that a company might choose to pursue? Dealing honestly and fairly with the customers on all occasions, provision of good working conditions and industrial relations, earnings above a particular level of return on capital employed. How many we have to choose? Two.
C and E.
Ma'am, one is C part, C option.
Okay. Okay. E is also right.
Yes, ma'am.
Okay. Level of gearing. Gearing is the proportion of the capitals which are used, that is debt capital and equity capital, because of the attributes about cost and the risk. If the cost is high, the profits will be low. So the cost is low, the profits will be better. So restricting the level of gearing, usage of debt capital, restricting debt capital and equity capital or the capital structure part of it, restricting the level of gearing to below a specified target level. Okay, so that is related to the financial aspect. Value for money is an important objective for not-for-profit organizations. Which of the following actions is consistent with increasing value for money?
C.
Decrease waste in the provision of service by a not-for-profit organization. C. Others are not correct. Okay. C is the this is on which E?
Economy.
Economy. First one is also talking about using cheaper source of goods, but here the quality is getting affected. So that is not economy. Searching for ways to diversify the finances of the not-for-profit organization. They are not focusing on earning profit. They are not working with the objective of earning profit. So they do not have to think about ways to diversify the profits, finances to maximize their profits is not the objective. D, focusing on meeting the financial objectives. Financial aspect is not the criteria here. So that then D is also not the correct one. Which of the following is least likely to fall within financial management? The dividend payment to shareholders is increased. Funds are raised to finance and investment project. Surplus assets are sold off. Non-executive directors are appointed to the remuneration committee. 1 and 2 are a part of financial management.
Yes.
Then between C and D?
D.
Okay.
Yes, the option.
C is surplus assets are sold off. So buying and selling of these assets also is a part of investment decisions. So that again is a part of financial management. So non-executive directors are appointed. Okay, this is related to the internal control, audit, those aspects of it, the management part of it. So non-executive directors are appointed, which is least likely to fall within financial management. Indicate by clicking in the relevant boxes whether the following statements are true or false. Financial management is concerned with long-term raising of finance and the allocation of control of resources.
True.
Yeah.
True.
Okay. Management accounting is concerned with providing information for more day-to-day functions of control and decision making. You've learned about management accounting, no? So F2 is a management accounting.
True.
So this is also done. What is financial accounting is concerned with providing information about the historical results of past plans and decisions.
True.
This
True.
is also true. Financial accounting is historical in nature and the account of the past transactions. Which of the following tasks would typically be carried out by a member of the financial management team?
A.
A is correct. Which two of the following are examples of internal stakeholders in a firm? Internal stakeholder. Many stakeholders are there.
Employees.
Employees and company directors.
Employees and company directors, customers, suppliers, and finance providers are all external. That's right. Then 10th one, what is the main purpose of corporate governance? Corporate governance, governing the corporate. Who governs the corporate? The management, the directors who are appointed, they run the business on behalf of the owner. So they work in the capacity of agents. So they are governing the corporate. They are governing the corporate with an objective of maximizing the profits for the owners. So the purpose or main purpose of corporate governance.
C or D.
Ma'am, according to me, it is D.
Ensure the regulatory frameworks are adhered to.
Yes, ma'am.
To separate ownership and management controls of organization to maximize shareholder value, to facilitate effective management of organization and to make organization more visibly accountable to a wide range of stakeholders, to ensure the regulatory frameworks are adhered to. Okay. C and D, both of them are correct, but the scope is much narrow in D. C talks about a wider range of their governance aspect. The scope of governance is clearly defined there. D is also part of it. They also have to ensure that the regulatory frameworks are adhered to, but that is only one part of it. The C talks about to facilitate effective management of organizations. So overall running of the business, the corporation, so effective management of organizations to make the organization more visibly accountable to a wide range of stakeholders. So this is overall management. D is correct, but it is quite kind of narrow. Okay, so C is the right one. The agency problem is this is the last question we'll take up, and then we'll end the class here. The agency problem is a driving force behind the growing importance attached to sound corporate governance. In this context, who are the agents?
Manager.
Okay. So we'll end the class here. Same time tomorrow. We'll start the class at 9 o'clock. Any doubts?
No, ma'am.
Okay. Okay. Ashley, I hope you will maintain. I do not know whether I have to give the attendance to the concerned faculty or anyone. But if at all, if anything like that is there, please look into that, and then because I do not even have the list of the students belonging to this class. So anytime if it arises, you please take care of
All right, ma'am.
that. Okay. Good day. See you tomorrow.
Thank you, ma'am.
Thank you, ma'am.